We turn now to Mohamed El-Erian for his perspective on today's Fed decision. He's the CEO and co-chief investment officer of PIMCO, the world's largest bond fund. And Mohamed, nice to have you on the program tonight. So I know that you think that the Fed did the right thing today. So tell us why, and what does this mean now for consumers, investors, and most importantly for businesses?
So it means the most for investors. Mr. Bernanke gave investors a big Christmas present, and it has three parts to it. First, he removed the uncertainty of when the Fed will taper and how they will taper. In fact, in his press conference, he even gave us a roadmap for the next 12 months. Second, they compensated what they've taken away with a lot. In particular, they told us that interest rates will remain low for a long time. And thirdly, they upgraded their economic projections. So put all that together, and the markets loved it. So for investors, it's great. For businesses, it's quite good because it increases the wealth effect, and therefore households are better off. But for the average person, and particularly for the unemployed person, it is not clear whether this will materially influence their outlook.
You know, Mohamed, Mr. Bernanke was asked today, and it was a question that he didn't really seem to have a particularly adroit answer to, and that is, why hasn't quantitative easing or the stimulus program created more jobs than it has, or has it at all done that? What do you say?
So I think what it has is avoided something much worse. So I'm with him when he says the counterfactual would have been much worse. I'm also with him when he says that we've dealt with a lot of unexpected things, from the European crisis to what's been happening on Capitol Hill. But fundamentally, it is not a perfect instrument. If you want to get very wonkish, it acts to what's called the asset channel. It's about making you feel better so that you go out and spend more, and then businesses invest more. So it's a very indirect way of stimulating the economy. A much better way would be on public investment, removing long-term uncertainty, doing all this other stuff. Unfortunately, the Fed is the only policy-making entity in play, and therefore they are using imperfect policy, and they're getting imperfect results.
One thing that we kept hearing today from Chairman Bernanke is that this promise, this reassurance that interest rates will stay exceptionally low. And we know that the markets, the stock market, has rallied on these low interest rates. So can we expect that through 2014? And does this change your approach to investing in stocks or bonds?
So clearly what they want to do is they want to maintain control of the short end of the yield curve. And why is that important? Because of the mortgage rate. So they don't want to shock the housing market because it's such a critical element of the recovery. So they are using aggressive forward policy guidance to try and convince people that short-term interest rates are going to remain stable. And today they largely succeeded on the short end. It's amazing that we had 300 points on the Dow, and yet the bond market was very well behaved. Now, in terms of what it means, you've heard us say this over and over again, Susie. Bill Gross has said it, I've said it. Be careful of where you invest on the yield curve. Do not go out 30 years. Do not go out 20 years. That's dangerous territory. Stay focused and stay concentrated at the short end of the curve. That's where the value is. That's where the relative safety is.
All right. Lots of great information. Thank you so much, Mohamed. Hope you have a happy holiday.
You too.
Mohamed El-Erian, CEO and co-chief investment officer at PIMCO.